I wanted to make a very special video and tell you about the top 3 dividend stocks that I think that any dividend investor should have as the foundation of their portfolio. And these are going to be my top 3 dividend stocks that I'd pick. And I also wanted to provide you with as much value as possible, and so I hit up my friend Ryan Williams, who runs one of the best dividend investing YouTube channels out there, and I asked him the exact same question. So not only are you going to get 3 amazing dividend stocks that you should definitely research and consider for your portfolio, but you're actually going to get 6. We also talk about the state of SCHD and what we think and how we're investing in it. So go ahead and listen in to our conversation here. All right. What's up, everybody? Hey, Ryan, how are you, man?
I am living the dream, my friend. How are you?
That's great, man. Look at that. We're doing the same thing. We're both living the dream. That's what I like to hear.
Love it, man.
Cool, man. Well, thanks for jumping on with me. We are going to be talking about our top 3 dividend stocks. But before we do that, I am getting in the comment section like crazy about SCHD. I'm sure that you're probably hearing the same thing because you're a big SCHD dividend investor as well. What are your thoughts on SCHD right now? At the end of October, it's down about 9%. And so what are you thinking for the rest of the year? What are you thinking long term? What are your thoughts?
I mean, long term, man, I feel great about it. We've talked about this before, but since it's down 9%, we can look at that as a sweet little discount, which in the grand scheme of things presents a pretty nice buying opportunity right now. So I'm not going to complain about that. But truth be told, I'm buying a SCHD every single week. I invest, the same amount of money into my Roth IRA, buy some SCHD. But outside of that, man, it's really not one that I spend too much time like keeping tabs on. SCHD in my mind, I'm sure it's the same for you. It's just one of those funds that you can really set it and forget it. So, man, I'm just focused on dollar cost averaging into it every single week. I'm not paying too much attention to the noise, a lot of the noise going around or going on in the market. Just focus on my buying.
Sweet. So just because it's down, you're not selling.
Oh, heavens no. Heck no.
Okay, good. Just making sure that we're on the same page here. Yeah, I mean, it's just one of those things. I mean, it's not fun. It's not cool to see your amount in your account go down a little bit. I mean, like you said, it's a buying opportunity. Of course, when you look at other funds, some of the more fun funds like the growth funds or even the S&P 500, they do have a lot more, technology and AI type stocks that are booming right now. And so it just makes sense that those are more fun, but just because SCHD is down a little bit for like the first time and it's like history, it's not cause for concern, or at least enough concern for you to be selling. So I'm with you, still continuing to buy, just dollar cost averaging, same exact way.
Yeah. And just kind of a quick closing thought on that, man, just for all you guys watching, just remember there's ebbs and flows in the markets. There's, if you're going to be investing for a long period of time, and even if you've only been investing for a couple of years or not a long period of time, you'll have experienced the ebbs and flows already. There's just so much up and down. There's going to be times where SCHD outperforms the S&P 500. There's going to be times where it underperforms. There's just going to be a lot of crisscrossing and zigzagging. All you can really control is what you're doing, which is how much you're investing. Control your emotional wits, try and stay strong through all this volatility. Those are the things you can control, and over a long investment career, that's really what you're best focusing on. So I just want to leave you guys with that.
Perfect. I couldn't have said that better, so I'm just going to leave it at that. Very cool. Well, let's get into the reason why we're making this video, which is the top 3 dividend stocks that pretty much any investor could invest in forever. It's just going to be some foundational, solid dividend stocks. I know I have 3, and I know you have 3. So start us off, Ryan. Number 3.
Okay, so my first pick out of 3 is going to be one of my favorite companies. We're talking about Starbucks. And I know a lot of you guys love the coffee. Some of you guys love the stock. I personally am a fan of both. And just some quick highlight stats around Starbucks. I mean, just in terms of the dividend, we're looking at about 2.4% dividend yield. So that's not too high. That's not too low. That's kind of a Goldilocks yield, especially when you consider Starbucks has a near 11% 5-year dividend growth rate. So this company has been a really strong dividend grower over the years, and they've got a pretty impressive track record of making those increases to the dividend. They've been growing it for the last 12 straight years. No signs of slowing down. I anticipate they'll keep that dividend growth streak going at least, well, I shouldn't predict, but hopefully they'll keep it going for a long period of time. I don't have any indication to believe otherwise. So the dividend stats are looking great. This is your standard high growth dividend stock. And you got to have some of those in the portfolio, especially if you have a long investment time horizon. These are the kind of stocks you want to be looking for. Now, in terms of its performance over the years. It's if we look at the 5-year performance on a total return basis, it's up 80%. That's a pretty solid return, especially when you consider it has outperformed the S&P 500 by about 20 percentage points. So in the same time period, the S&P is up about 57% over the last 5 years. So Starbucks, nice history of outperforming the S&P. Year to date, that's not so much the case. They're down compared to the S&P that's up about 9% in 2023. But once again, like we were saying with SCHD a moment ago, this is a good buying opportunity. I think Starbucks is somewhere close to about $90 per share. So if you don't have any shares, or even if you have some shares and the share price is below your current cost basis, not a bad time to be averaging down or averaging into Starbucks, in my opinion. Now, why do I think this is going to be a good stock to hold on to forever? Why is this a good long-term hold? I mean, you guys know you can drive by more or less any Starbucks, especially in the mornings. You're going to see pretty busy drive-through. You're going to see a lot of people just, Starbucks is always packed. That's just one of the things about it. The average consumer, people who are customers of Starbucks, yes, it's $5 coffee, but to them, it's money well spent. And a lot of these people will cut out a lot of other things from their budget before they get rid of their Starbucks for many people. So I think Starbucks is a pretty safe one to buy and hold for the long term. And that aside too, I'll try not to ramble too much longer on this, Nolan, but just some other things about the company aside. Over the years, the company has done very well with developing and evolving with their customers, which is one of the reasons they're such a sticky brand. I mean, number one, increased personalization for ordering. You can go to Starbucks and customize the drink any which way you want. And I read something that there's like 383 billion ways to customize your drink, which is a positive experience for customers that definitely makes them want to keep coming back. A lot of people, they have a really strong customer loyalty program. Their app, I think at this point, has over 31 million active users, and a lot of them have money loaded onto their Starbucks card, which is basically like pre-purchasing for drinks, to the effect of about $2.8 billion worth. So that's a lot of money that the company can use now to further its growth, keep in the bank, do whatever. So people are paying in advance for their Starbucks. So it's one of the biggest positions in my portfolio. It's number 2. And if it continues to head south, I'll definitely be adding more myself.
Nice, man. Yeah, I mean, Starbucks, I don't think you can disagree too much with that company being around forever. I know for a fact that it's one of my students' favorite places to be, because even if they're going to be late to my class, they're definitely walking in with that little Starbucks cup. So they don't care about the penalty for being late as long as they have their Starbucks. So I can definitely attest to that. Well, my number 3 stock on this list is going to be none other than Coca-Cola. I think that anytime anybody talks about dividend stocks, I think Coca-Cola is making that list. It's been around for quite some time. It's one of the strongest companies just that we have in the United States. A couple of stats for Coca-Cola. They have a 3.28% dividend yield, which is solid. The years of consistent dividend growth, not just having a dividend, but dividend growth, is for 61 years. So, I mean, the consistency alone on that, you can really, the point of this video is to find stocks that you can buy and hold forever, right? And so what I'm looking for is consistency. That's one of the main things I care about. The price appreciation over the last 5 years is up 22%, which is not high. It's actually not great, to be honest, but the year-to-date performance is negative 10.95%, or down about 11%. So including this year, that 5-year would look even better if we didn't have this year, but we do have this year. So all that I see when I see that is just it's on sale, just like we were talking about with SCHD, just like we're going to talk about with probably a good amount of these stocks. And the idea is that just because the price is down doesn't make the company bad. It doesn't make the product bad. It makes it actually more of a value position, and that should be enticing for us dividend investors. It owns or licenses more than 500 non-alcoholic beverages, including both sparkling and still beverages. It now sells products in more than 200 countries around the world and has 20 brands that each generate $1 billion or more in annual sales. According to Forbes, Coca-Cola is the 6th most valuable brand in the world. The Coca-Cola brand is reportedly worth $64.4 billion. I mean, the numbers are there. The absolute competitive advantage is there. It's just a brand that is so much bigger than a beverage. It's so much bigger than just a soda, right? It is the king.
Yeah. So adding one thing to Coca-Cola, one might look at this company that's been around for, I think well over 100 years at this point and think, gosh, like how can this company grow? Like how you'd think that anyone who's familiar with Coca-Cola at this point would be drinking it. How are they going to get new people to drink the product that's been around for so long? It might be a hard grower, especially because it's such an old company, but they just put out some really killer numbers in their quarterly earnings. And I think, there's not as much growth here in the United States, but outside of the States internationally, I think in Latin America specifically, this company is really taken off. So there's still a lot of growth left in this company, and it helps to diversify their product base outside of just the soda.
Yep, definitely. And it'll be here to stay. Very good. Cool. What's your number 2 dividend stock, Ryan?
So my number 2 is, like Coca-Cola, a dividend king. This one is about as steady as it gets. This is Procter Gamble, which, like I said, is as steady as it gets. Their products, for those of you who don't know, are household essentials. We're talking things like laundry detergent, dish soap, other types of soap, shampoo, conditioner, deodorant, toothpaste, etc. So we're talking products that no matter what's going on in the world, literally no matter what's happening, these are products that you cannot go without. The forward yield, very similar to what we saw with Starbucks. We're looking at about 2.5% for the dividend yield. So not too high, not too low. Now for the 5-year growth rate, very moderate, 5.6% over the last 5 years. Not as high as what we saw with Starbucks. And I think that's also actually pretty comparable to what we're getting with Coca-Cola right now. But pretty Goldilocks number. It's not that low, but it's not crazy high. But this is where Procter & Gamble really shines, the dividend growth history. They've been growing this dividend for the last 67 straight years. So like I said, right up there with Coca-Cola, they are a dividend king. And I just don't think it can get much more safe and steady and reliable than Procter & Gamble. Now, in terms of the returns, it's actually even better than Starbucks. Over the last 5 years, Procter & Gamble is up about 94.5% on a total return basis, which means that they have outperformed the S&P 500, this boring company that sells soap, that sells laundry detergent, that sells toothpaste, has outperformed the S&P by about 40% in that time period. Now, year to date, it's not looking as good. The S&P does have the advantage. S&P, once again, is up about 9% compared to Procter & Gamble. Like Starbucks, this is one of the biggest positions in my portfolio. I think it's number 3. I think it's right there behind Starbucks, actually. But I love this company so much. It's one of my favorite dividend stocks. So definitely one that I think you can buy and hold forever. And speaking personally, that's something that I plan to do.
Amazing. Yeah. I mean, again, just like I was saying with Coca-Cola, you talk to a dividend investor that's been doing it for any period of time, I'm sure P&G is in their portfolio. This is the model of consistency. This is something that's going to be recession proof, right? People need to buy this stuff no matter what, and they're not going to not buy soap. They're not going to not buy detergent. They're not very expensive products. It's just a beautiful, just perfect company there.
Yeah.
Awesome. Well, my number 2 is going a whole different way. So my number 2 is actually my number 1 position of individual stocks that I own, and that's going to be Microsoft. Now, Microsoft, I'm sure I'm going to get some comments down in the comment section on if it's a dividend stock or not, but I'll make a case for it. Don't worry. So yes, their dividend is nothing to write home about. It's actually a 0.88% dividend. So that is not very high. It's not even 1%, but in the amount of price appreciation that we're going to see from Microsoft and for what we keep seeing and how much growth there is in this company, having a small percentage of a larger number is still, in the end, dollar amount, a very, very solid little dividend that you're getting along with, like I said, the price appreciation for this company. Microsoft's increased its dividend regularly over the past 10 years, often at an annual rate of 10% or better. The price appreciation over the past 5 years, over 217%. So if we're talking about outgrowing the S&P 500, if we're talking about, looking at something deeper than just the yield itself, this definitely needs to enter the chat. And so I like that number there. Year to date, it's up almost 42%, just year to date, 2023. Obviously, there's a bunch of reasons why this company is going to be around for a long period of time. But for me, right now, the AI boom it's all centered around ChatGPT. It's all centered around the technology that Microsoft either owns or has a part in. Microsoft's investment in ChatGPT is expected to start yielding as parent company OpenAI rapidly approaches $1 billion in annual sales. Microsoft recently integrated ChatGPT onto its cloud platform. Microsoft's one of the leading players in the cloud computing space, along with Google and Amazon, and Microsoft's just one of the best stocks for dividend and growth investors to hold in their portfolios long term. And now, before we get to our number one, Ryan and I have an announcement. We actually built out an all-in-one course for dividend investing, including everything from how dividends are taxed, how to actually analyze a good dividend investment, and even how to build the perfect dividend portfolio. The link to buy is down in the description of this video, so check that out after this. So Ryan, you built about half of this course. What's something that you think that somebody would find value specifically in a course like this?
Man, that's a really good question. And first of all, thank you so much once again. I know I've thanked you 1,000 times, but thank you for allowing me to be a part of it. I really enjoyed making the videos. I think it's fantastic what we put together. And to answer the question, I think if you're someone who is really just getting started with this stuff and want to make sure you're getting started on the right foot, I think that's what this course is perfect for. You're going to learn really invaluable things like what to look for, how to structure your portfolio, what you should be, basically what your portfolio should look like when first starting out, how you can go about finding the right stocks to invest in, how you can go about tracking your portfolio to make sure that you're headed in the right direction. There's just so many things that you'll learn as someone who's brand new to investing that I wish I would have had when I first started, because I can tell you, I just feel like I made so many mistakes as a brand new investor, and I still make them today. And being able to have something like this, a resource that is prepackaged and very well organized from start to finish, is just going to save you a lot of time. It's going to save you a lot of headaches, and hopefully it's going to save you from losing a lot of money. That's the hope. But overall, I'm really excited for you guys to check it out. I think you'll really enjoy it. And I think it's a great course. So.
Awesome. All right. Without further ado, let's hear your number one dividend stock.
Okay, man. So my number one stock, and by the way, too, like these aren't really in any particular order. It's not like this one's the best, but the last stock that I want to share with you guys is one that you maybe not have heard of before. This one is a company called American States Water Company, ticker symbol AWR. Now, what this company is, it is one of the country's largest water utility companies, and they operate out of California, where they service about 260,000 people up and down the state. But in addition to that, they also have a clientele base that includes different military bases throughout the country. So in regards to utility companies in general, they are typically regarded as being pretty steady investments. Electricity, gas utilities, water utilities, just kind of like we were talking about with Procter Gamble. There are things that you're going to need no matter what's going on. You got to pay your utility bill every single month, right? So they're pretty steady in that regard. Plus, they're heavily regulated, which also adds some sort of, it's kind of a pro and a con, but it can also add some stability there as well. 2% dividend yield. Okay, not too bad. Not too bad. If we look at the 5-year dividend growth rate, we're looking at 9.3%, which is very comfortable. I would consider that on the higher end of dividend growth rates. So, even though you're not getting the highest starting yield, which you guys shouldn't be getting hung up on high yields in the first place. Also, American States Water has 69 years of dividend growth. So they are the king of dividend kings. I think they might have one of the longest dividend growth histories out of all of the dividend stocks out there. And they've been paying a dividend every year since 1931. So really solid track record of providing cash flow for shareholders. If you are, if you have a long-term time horizon, or if you're someone who is looking for stability in retirement, I think it can offer a benefit for both types of individuals, both types of investors. Year to date, they're down compared to the S&P's 9% gain. So potential buying opportunity there. But here's where American States really does outperform. If we zoom out across a longer period of time, look at the 10-year returns. It is up 234.7% compared to the S&P, which is only up 137%. So we're looking at a near 100% spread between the two there over the last 10 years. So, American States Water, once again, this really boring company that isn't super innovative, doesn't do anything crazy to reinvent the wheel or change the world or start a revolution, has returned more money to shareholders and has just offered better gains than the S&P 500 as a whole.
I love it. And I think that, at the end of the day, a lot of these companies that we're choosing are somewhat boring companies, right? They're not really doing anything too crazy. I mean, Microsoft is, but like for the most part, your foundational dividend ETFs, I mean, dividend stocks should definitely be somewhat boring and consistent and just something that's always going to be there. All right, well, my number one dividend stock is actually one that most of you guys probably already know. It actually has a 6.24% dividend yield. But the reason why this is so high is this is more than just a stock, it's actually a REIT. And this is Realty Income. And Realty Income is a dividend aristocrat, consistently grown its dividend for 29 years. The problem that we're seeing though nowadays is that it is down, right? For the last 5 years, it's actually negative 14.85%. Year to date, down almost 23%. But real quick, Realty Income, they own over 12,000 properties, of which they lease to clients across 84 industries. Most tenants fall under recession-resistant industries. Some of their top clients include investment-grade companies such as 7-Eleven, Walgreens, Dollar General, and FedEx. There's so many positives about this specific company because the types of tenants that they have are just huge companies that are likely not going to fail. Again, they are recession resistant type companies as well. This is exactly the time to be buying when other people are scared. And so for me, I really like it. I think that at the end of the day, their business model hasn't changed. It's been there and have worked when the interest rates are lower. And so eventually interest rates will get lower and they'll go back down. And one of the biggest reasons why I really like specifically Realty Income, but really a lot of REITs are creeping more into my portfolio is because I am such a high investor in SCHD, and SCHD doesn't have any real estate within it. So for me personally, this is why I put it as my number one.
Love it, man.
Like I was saying, one of the biggest reasons why I pick Realty Income as my number one dividend stock that I would invest in, and actually I'm pretty high on a couple of other REITs as well, is because I'm a heavy investor in SCHD. One of the main sectors that SCHD does not have any of is real estate. In order to diversify, this may be a very solid option. Not to mention the fact that these REITs have incredibly high dividends. To learn more on REITs, here's a video that I did on my favorite top ones. And to learn more about my price prediction for SCHD by 2030, watch this video as well. And remember to check out the Dividend Masters course with the link down in my description.